Greetings to everyone and welcome to week number 7 of our semester together. Hopefully everyone is doing well. As I mentioned in my announcement, apologies for not being able to be with you tonight. Had a work-related conflict that's going to go into the evening. Just wanted to make sure I sent a video highlighting some of the things of chapter 7 and some of the things related to mergers and acquisitions, especially I think the positives that can come from acquisitions and some of the challenges that occur with mergers. So as we dive in and look at some of these types of things, mergers are where two firms agree to integrate their operations on a co-equal basis, and that co-equal basis sometimes I think is what leads to some of the struggles with mergers. I think there's a lot of times there's probably acquisitions which maybe just to make it a friendly PR move or make it the tone or the messaging sound friendlier. We call it a merger when it really is an acquisition. When it's an acquisition, one firm buys a controlling interest in an organization or 100% interest, right? And that business that's purchased, right, becomes part of the portfolio of that larger business. One of the reasons that acquisitions tend to be more successful is because usually there's a pretty prescribed and pretty well laid out hierarchy of who's making the decisions, right? Whose staff are we keeping? Where are there going to be investments made going forward? Are there locations that are combining, merging, closing, right? Anytime there's an acquisition or a merger, that diversification piece, you're looking for economies of scale, economies of scope, and at times, right, where there's duplication, you may look to eliminate that duplication, and that can be scary, right? I mean, if we're employees of an organization that's merging or acquiring, we have to ask ourselves, and it's a legitimate question to ask, right? Is my role, is there a duplication of my role somewhere? Could my role be eliminated, right? Will I have a new role? Will I have to move? Will things change, right? So anytime there is a large-scale merger or acquisition, there is some uncertainty. So one of the key base foundational strategies you have to consider is your human resources strategy. You have to identify the key talent to make sure that you can move forward with that acquisition, move forward with that merger in a successful way, right? Because if you lose your key people, some of your top people who could help that merger or acquisition be successful, you just kind of doomed it to failure and it really kind of struggles. As we look at some of the problems in achieving success or some reasons for acquisitions, right? Some of the reasons for acquisition are increased market power, right? We can take out competitors, increase our market share. We can overcome entry barriers into an industry, right? Gain some resources, gain some core competencies. Certainly, if it's international, we can overcome perhaps barriers there. Cost of new product development. The cost of new product development can take a long time, and it can increase your speed to launch a new product, right? You don't have to go through that whole R&D cycle. You might have some new learning and development capabilities, bring some new capabilities, resources, competencies in your organization. It could reshape your competitive scope, change who your main competitors are, perhaps less reliance on one product or service or one product line, right? It certainly can increase your diversification, and there can be lots of good reasons for that. And it can also lower your risk compared to developing new products. We know that the success rate of R&D and new product development is not high, right? The ones that they hit on usually hit on pretty big, but it's kind of like a weather forecast, right? It can be hit or miss. So those can be good reasons for acquisitions. Some problems in achieving success, right? There can be integration difficulties, right? We're integrating people, managerial styles, organizational cultures, technology, purchasing systems, payroll systems, all those types of things that we're integrating new, right? What if we're inadequately evaluating our target, right? We don't understand the competencies we're getting. We don't understand the target that we're getting to. Maybe they've got a flashy product or a big brand name and we think that's valuable, but maybe it's, the alignment with what we're doing isn't quite as strong as we think, right? If there's larger extraordinary debt, so we acquire a company and then we realize, and this is kind of part of the inadequate evaluation, what if we take on too much debt, either too much of their debt or we take on too much debt to acquire the company with our purchasing price? And I've mentioned that in the past, those bidding wars, right? You can win the battle, right? You can win the bidding war, but you can lose the longer term battle, right? And that can be the problem, right? You can win that fight, but lose the bigger battle down the road. It could be too large of an acquisition. You don't have the resources to manage it. Certainly the managerial opportunism and the opportunities for diversification acquisition, where it's all driven by managers wanting to increase their resume or increase their reputation or increase their compensation. Too much diversification, if we become too heavily diversified, and that can be just like too large of a diversification. We don't have the necessary skill sets, human resources to successfully manage and shepherd that acquisition. And then you can't achieve synergy, right? So one of the reasons, acquisitions can be successful, mergers, that inability to achieve synergy. I mentioned in my announcement this week when talking about this content that some of the struggles around mergers, because mergers, a lot of times you'll hear a merger pitched as a merger of two equals. And one of the key struggles that can bring forth, if it's a merger of equals, right, who's making the decisions, right? And in the content for this week, I have, four epic failed mergers, right? Sears and Kmart, right? Sears and Kmart by the early 2000s, both were losing market share. They were losing their perception and idea of how they could create value, how they could connect to their target market, right? And a lot of these failed mergers, even failed acquisitions, it seems like if there's a common thread, it's two organizations maybe who are starting to lose touch with their target market, starting to lose what their concept of value is, lose sight of their value proposition, maybe stray too far from their core competencies, right? And now they're struggling. So, well, let's just take two companies and either through merger or acquisition, and unfortunately more often it's through merger, let's just put them under one roof, right? So take two failed companies, put them under one large roof, and suddenly we're going to have a successful company. You know what you just probably created is a bigger mess and more dysfunction and bigger losses, right? For investors, for stakeholders, for employees, for customers, and for communities that those businesses operate in. But, the Kmart and Sears, right? Kmart and Sears merged. They both already were starting to have financial and performance issues on all sorts of levels, more than just financial. And as we look at that, right, Kmart and Sears, once they merged, they operated stores like within less than a mile of each other, right? They were literally next door, right? They're all one company. They're competing against each other. And because it was a merger, and they almost called it like a merger of equals, no one was deciding like, hey, we need to close one of these locations and make one stronger store instead of having these two kind of diluted, confusing stores, right? No one understood what the brand was. Kmart, Sears, same company merged together. What's the brand promise? What's the wow factor for consumers, right? And if we think of that industry that they compete in, right, that consumer goods retail industry, right? You think of Kmart and Sears going up against Walmart, Meijer, Target, Kroger, right? The Costco's of the world. Where's the room for them to create value, right? And they were already, like I said, losing market share and losing their understanding of how they could create value for their target market, right? Now they've got increased competition and they create two companies into one big one, right? They didn't close locations. They didn't merge product lines, right? How many clothing lines of Kmart did you see in Sears after that merger, right? They should have shared that. Sears had struggled for a long time to gain a foothold in clothing, right? But they didn't take any of Kmart's clothing lines, right, and pull them over. Especially I'm thinking like that Jaclyn Smith women's clothing line, right? How many Craftsman's tractors or Craftsman tools did you see in the Kmart, right? Or Kenmore Appliances, which was a successful brand for Sears. How many of those did you see in the Kmart, right? They just kept on running these two parallel companies, same supply chain, same products and brands, never taking what was successful of each, right, and making one strong company, right? And of course, it all went bankrupt many years later. It's one of the examples on that sheet, right? You look at Daimler-Benz and Chrysler, right? So Daimler-Benz, Mercedes-Benz took Chrysler, right, over for a while, and they paid $36 billion for the rights to acquire Chrysler, right? Several years later, they had to pay someone, Cerebus Capital, $650 million to take Chrysler off their hands. So not only did they take something that was worth $36 billion and ruin it so badly through a merger to go down to $650 million, now they had to pay someone an additional $650 million, right? So really, really, disastrous things. And it's because there's no one clearly calling the shots, no one setting a strategy, no one how to successfully execute a strategy, no one deciding like, hey, here's the best of what we both can offer, but here's some things that maybe haven't been working for either one of us and we should just stop doing, right? Those are difficult decisions even in companies that are running effectively and efficiently. Now imagine, right, if you have two companies maybe that aren't running effectively and efficiently, and now they tried to merge together under one roof, right? So that's some of the struggles, right? I would encourage you to look at some of those types of opportunities or some of those examples that I shared, right? Mergers are historically unsuccessful. They don't meet their revenue targets. They certainly don't meet their synergy targets. Over 70% of them miss their synergy targets, right? Yet, rhetorically, I would ask you to think about maybe over the next couple of days, why do companies still engage in mergers? A true merger, right? Again, I said I think a lot of acquisitions are put out in the press and put out and advertised as mergers, maybe because it seems a little friendlier. But how many true mergers, right, are successful, and why do people still engage in them? 70% miss their synergy and revenue targets, right? I mean, that's a profound failure rate. That means only 3 out of 10 are successful, right? I mean, that's a pretty strong critique against mergers, right? But we look at mergers, we look at acquisitions, they're different. In acquisitions, you generally have someone, right, calling the shots, and those shots can be difficult to call, right? If we look at, some of the problems in achieving success, right, even when you've got someone clearly making the decisions, right? Things like software programs and technology and managerial styles and brand perception and all those types of things, right? Even when you've got differences in that, someone's calling the shots, those can be challenging. Now, there's no clear hierarchy, who's calling the shots, who's making the decisions, right? And who needs to make the decisions. And now you combine all those difficulties in that kind of environment, right? And it becomes pretty challenging. So acquisitions can increase your market power, right? You can sell goods or services above competitive levels. You might be able to reduce the cost of your goods sold, get synergy in supply chain, right? And that's good, right? Obviously, acquisitions are, financial markets are going to analyze them and they're going to vote with their feet and their dollars, right? Financial investors and stakeholders, customers can, vote with their feet and their dollars, go to somewhere else, not spend their money. So can financial markets and investors. They can vote with their dollars and say, we don't want a piece of this, right? And of course, in that Sears and Kmart story, it became apparent really quickly that investors in financial markets took their dollars and they walked, right? And they continue to walk, right? To the point where they don't exist anymore, right? So that happened, right? And certainly there's all sorts of different kind of acquisitions, right, that we talked about. You can have a horizontal acquisition where you go out and acquire someone in your industry, right? Vertical acquisitions, right, where you acquire a supplier or distributor of your product or services, right? So all sorts of different kinds of acquisitions that we can have, right? And they all serve certain purposes, right? Certainly overcoming entry barriers, as I mentioned, is a key valuable piece of an acquisition, right? You can go and acquire a company, certainly if it helps you get into a new region or certainly a new country, right? Go over the, a border and do some international expansion and have an acquisition, or even maybe some type of merger where you can partner with someone who's a domestic supplier, right? Where maybe they've gained some trust in that country that can help overcome some of those challenges of international expansion, right? Talked about, new product development is often very risky. So if we can help overcome some of those types of things, becomes really important. There's lower risk, right, to compare to developing new products, right? New products, costly. Who's making those decisions? R&D, right? If we can acquire some technology, acquire some research, right? Even if it's maybe 40, 50, or 60% down the road to a product launch, right? Now, it's important to remember acquisition is not a replacement for innovation, right? If every time you need a new idea, you just go acquire someone else's technology, right? What does that say about your company, right? What does that say about maybe either people you hire or how you view the people that you have? And if you've got really talented people, you do have really talented people in your organization, if you constantly go acquire a new idea and never let them innovate something internal, your best talent's probably going to leave, right? So acquisition is never a replacement for innovation, a very key strategic piece to remember. You certainly can, diversify your portfolio. Those are all good things to do through acquisition, right? Both related and unrelated. It's probably like stating the obvious, but the more related the acquired firm is to the acquiring firm. So if I'm buying a company, the closer we have of core competencies, maybe even in the same industry, similar target markets, similar demographics for customers, right? The higher the probability that acquisition is going to be successful, right? We know what we're acquiring. We understand what we're getting. We probably got a good plan to bring it into our company, right? We're probably expanding our market share, right? Serving some of the customers maybe that we were struggling to get before, but now we acquired this other company, so we get their customers, and hey, their customers are a lot like ours, so that tends to work really pretty well, right? Some good things, and certainly we can't ignore, right? When we do acquisition, I mentioned there's sometimes some uncertainty, as far as who's staying, who's going, whose products or services, what locations are staying open, potentially closing, right? Some of those are unfortunate, tough decisions, but also you can get some new learning and development going on, right? L&D, OD&L, organizational development and learning, some new capabilities, right? Potentially you can reduce some of the a nursery. Maybe you can break through some things, get some things moving again, right? Infuse some energy into the company, which is really pretty strong and pretty good to have and to know, right? So, those integration challenges, you've got two different cultures, right? I talked about financial control systems. Managerial style is different. Different organizational cultures can be really challenging, especially when it comes to leadership and management and how they view leadership and management, right? And again, the key thing, you got to identify the key personnel. You got to let them know, like, we're with you through this. We see you as a key piece going forward, this newly acquired or newly merged company, and what we're trying to establish here, some discernible brand equity and something discernible to customers as we've done this acquisition or this merger, right? And we need you as an employee to be a part of that. We see your talents is crucial to the success that we're trying to achieve, right? And certainly financial considerations shouldn't be overlooked, right? A lot of times, what does a balance sheet look like? Have previous executive teams manipulated the balance sheet so a company looks like a good acquisition target, and maybe it's not. Maybe they're hiding a lot of debt, hiding a lot of junk bonds and things like that. So that's where, doing your due diligence financially and having some people who are really strong at that financial analysis and that financial risk analysis in your organization is important. Certainly if you're going to do merger and acquisition strategy, besides understanding, what capabilities and competencies do we need and should we acquire? Is this a fair price? Are we acquiring what we think we're going to from a for what we're paying, but then are we not taking on too much risk, right? And then it's certainly identifying, having someone work through the cultural leadership, I want to call them a soft skill, but the human behavior side of that and the HR strategy side, right? If you're going to be a merger and acquisition company, that's how you're going to grow, right? You definitely need to have some really key competencies leading a merger and acquisition strategy and at the table when those conversations are going on, right? So acquisitions can be successful, right? Certainly having the right assets and resources are important if an acquisition is friendly, right? If it's more sought out or sought after versus if it's a more hostile kind of takeover, right? Certainly if you have resources available, slack cash, slack resources, you acquired the company, but yet you have capital resources to maximize that acquisition is important, right? Certainly, both organizations being on a solid financial footing, right? And just fully understanding the core competencies you're getting, right? So mergers and acquisitions, they can be a key part of our strategy. They can get us into new markets. They can reduce competition, right? They can allow us to get some additional core competencies, position ourselves for future growth and for what the future holds, right? There can be some less risk in developing new products if we can acquire something. But remember, acquisition is not a replacement for innovation. Certainly in an acquisition where there's that hierarchy, that kind of decision-making hierarchy tends to make acquisitions much more successful, much less risky than a merger, right? Because acquisitions and mergers have some of the same challenges. But if you think of while we're making those decisions, if there's not a clear decision-making hierarchy, those decisions become even more complicated, probably more drawn out, and probably more difficult to make, right? So those are some things we need to think through. And as I mentioned, a lot of the mergers miss their synergy targets, right? You look at Sears and Kmart, you look at what Chrysler and Mercedes-Benz went through. You look at Nextel and Sprint, which shut down, Countrywide and Bank of America, mortgage things, some of those acquisitions. Those were disastrous, right? And those are some of the worst examples, right? So when it comes to mergers, right, when you talk about a merger of equals, that's clouding that decision making. And there's just a lot of examples of mergers that have been less than successful. And historically, as I said, the data shows that mergers miss their synergy and revenue targets like 70% of the time. Acquisitions tend to be much more successful. So just kind of a highlight look at mergers and acquisitions. They can be an important piece of our strategy. Go out, look for some, maybe look for some examples that have been successful. I'll challenge you to do that. And then look for some examples maybe that have been less than stellar and see how they relate to some of the things that I've shared here. We'll be back with everybody next week. We will have all of our modalities available. We will have Class for Teams available or the online discussions. Looking forward to hearing case studies, additional company updates. We'll get back to those. And as always, if you have any questions, feel free to reach out. Thank you so much.